Something big just happened in the global economy. So big that it wiped out trillions in market value almost overnight. But unless you were watching closely, you might have missed it. No explosions, no breaking news banners. Just a quiet shift from a familiar friend that sent shockwaves through Wall Street. A move so calculated, so symbolic, it rattled investors, stunned policymakers, and cracked open a question no one wanted to ask out loud. What happens when the people who once backed you start backing away? This wasn't a threat or a press conference. It was a signal, measured, deliberate, and deeply unsettling. And it came from a country that's been one of America's most dependable financial partners for decades. Now that long-standing trust is being tested, and the consequences are beginning to show, not just in the markets, but across trade routes, currency reserves, and even legal foundations. The story begins with a sell-off, but it doesn't end there. For decades, Japan stood quietly behind the scenes of America's financial strength. It was the largest foreign holder of U.S. Treasury bonds, second only to the Federal Reserve. Through wars, recessions, and political storms, Japan kept buying U.S. debt, helping fund the very system that powered the global economy. But in early 2025, that trust began to unravel. Japan slashed its U.S. Treasury holdings by over $119 billion in just one quarter, the sharpest drop since 2012. That wasn't a blip. It was a statement. The Bank of Japan explained the move as part of a domestic shift, adjusting its own yield curve and liquidity needs. But that explanation didn't convince everyone. Analysts from HSBC and Nomura called it a preemptive hedge against growing U.S. fiscal uncertainty. With America's deficit ballooning past $1.8 trillion in 2024 and bond yields rising fast, holding U.S. debt has become a riskier game, especially for a country like Japan, where even slight interest rate shifts can shake its fragile recovery. Behind closed doors, Japanese policymakers had been voicing quiet frustration. Trump's return to power brought new tariffs, new uncertainty, and a wave of protectionist policies. In response, Tokyo didn't escalate with angry words. It responded with numbers, pulling money out of the U.S. Treasury market and redirecting its focus to Asia. According to Bloomberg, Japan has been actively expanding talks with ASEAN nations about using the yen in regional trade settlements. Not long ago, this would have been unthinkable. Now it's policy. In the wake of sweeping new U.S. tariffs on autos and steel, Tokyo has quietly but decisively widened its foreign policy aperture. According to the Global Times, Japan, historically cautious about deepening regional economic entanglements, has recently shown rare enthusiasm for trilateral cooperation with China and South Korea. High-level forums in Seoul and plans for the upcoming summit in Tokyo signal a reinvigoration of diplomatic outreach, supply chain coordination, and negotiations toward a potential China-Japan-South Korea FTA. This shift isn't emotional, it's strategic. Japan understands the global monetary order is changing. The dollar still dominates, but cracks are showing. Treasury auctions are weaker, bond volatility is up, and countries that once depended on the U.S. as a stable anchor are starting to look elsewhere. Japan's move signals that it doesn't want to be caught off guard. It's not abandoning the U.S., but it's preparing for a world where the dollar no longer writes all the rules. At the same time, Japan is quietly building leverage where it matters most: technology and energy. While U.S. politicians are stuck in trade fights, Japanese firms are taking the lead in solid-state battery innovation, locking in future dominance in electric vehicles and storage systems. And with that dominance comes influence, not just over markets, but over trade policy itself. As Tokyo repositions its financial strategy, it's also strengthening its negotiating power. And that power is about to come into play. In March 2025, the U.S. announced a 25% tariff on all imported passenger vehicles, encompassing Japanese-made EVs, citing national security and trade distortion safeguards. For Tokyo, the move felt strategic. Just months after Japan teased a breakthrough solid-state battery prototype, aiming for up to 750 miles of range and 10-minute charges in trials by 2027, the tariff underscored rising geopolitical and economic friction. Japan's leaders called the decision extremely disappointing and warned it could derail Tokyo's lead in next-generation EV tech. The US tariffs landed like a slap. Japanese officials were blindsided. Automakers, especially those investing heavily in next-gen battery tech, saw it as a punishment for innovation. Nissan's CEO publicly warned that the move would disrupt global supply chains. Behind the scenes, Tokyo began recalibrating. Retaliating through trade would escalate tensions. But Japan had another lever, one that would hit Washington where it hurt most: the bond market. By early 2025, Japan was still one of the largest foreign holders of US Treasuries, but its commitment was fading fast. It controlled hundreds of billions in US debt, and that kind of leverage doesn't go unnoticed. When the US imposed steep tariffs on Japanese vehicles, Tokyo didn't retaliate with countermeasures or threats. Instead, it made a quiet but powerful move, accelerating its exit from the US bond market. Yields spiked. Wall Street stumbled. Investors around the world took notice. Without a single press release, Japan sent a clear signal. In this economic standoff, it wouldn't need noise to make an impact. This wasn't an impulsive reaction. Japan had watched for months as US trade policies grew more unpredictable. The EV tariffs were simply the breaking point, and they arrived at a moment when Japan held unusual leverage. According to reports, Japanese firms control over 48% of the world's solid-state battery patents. That's not just an edge, it's dominance. Toyota and Panasonic, already years into joint development, announced a new electric vehicle platform set for global rollout in 2026. European pre-orders surged. Meanwhile, US companies like Ford and GM faced production delays and rising costs, partly due to restricted access to key battery materials like graphite from China. That imbalance gave Japan a unique advantage. It didn't need a shouting match. Its technology, market leadership, and financial moves spoke louder, and Washington began to feel the pressure. As Japan tightened its grip on the future of clean energy, it also sent a clear signal. Economic influence isn't just about how much you export. It's about how strategically you use what the world depends on. When Japan offloaded over $100 billion in US Treasuries, the markets didn't just flinch, they trembled. In the weeks that followed, US 10-year bond yields surged to 4.89%, their highest level since 2007. That number might sound abstract, but the impact was very real. Higher yields mean higher borrowing costs across the board, from mortgages and student loans to corporate debt and government spending. In short, money just got more expensive in America. The sudden sell-off wasn't happening in a vacuum. Investors around the world took notice. Confidence in US Treasuries, long seen as the safest asset on Earth, started to weaken. According to MarketWatch, global demand at Treasury auctions thinned. Foreign bids dropped, forcing the US government to offer higher returns just to attract buyers. And that's a problem. The Congressional Budget Office warned that if yields stay elevated, annual interest payments on US debt could rise by $270 billion by 2027. That's more than the entire budget of the Department of Education. Other countries weren't waiting to see what would happen next. Central banks from South Korea to the UAE trimmed their dollar reserves, quietly shifting toward alternative assets like gold, the euro, and even the Chinese yuan. This kind of realignment used to be unthinkable. Now it's becoming a trend. According to the IMF's March 2025 report, the dollar's share of global reserves slipped to 54%, down from 59% in 2022 and 62% in 2020. The decline may seem gradual, but for the global reserve currency, even small shifts can have massive ripple effects. The dollar index, a key gauge of the greenback's strength against major currencies, had dropped 11% since the start of the year, marking its worst start of the year since 1973. That kind of plunge is typically seen during global crises, but this time there was no sudden collapse, no flashpoint, just a slow, steady erosion of confidence. Around the world, investors and central banks began to question what was once unthinkable, that the dollar might no longer be invincible. For households and businesses across America, the fallout was immediate. Mortgage rates jumped. Credit card interest climbed. Corporations paused hiring and cut back on investment. On Wall Street, volatility returned. Investors didn't just see risk, they saw instability. And that's what spooks capital the most. Japan's move may have lit the fuse, but what followed revealed a deeper problem. The U.S. financial system, once a pillar of stability, is starting to look shaky from the outside. And when the world begins to question the foundation, everything built on top of it starts to wobble. The U.S. dollar has long been more than just a currency. It's been a symbol of global trust. Governments, banks, and investors relied on it not just because of America's economic size, but because of its institutions, independent courts, predictable policy, and the rule of law. But that foundation is starting to show signs of stress, and the cracks are no longer just financial. They're institutional. By early 2025, the shift away from the dollar was no longer theoretical. It was visible in trade flows, investment strategies, and diplomatic behavior. More cross-border transactions were being settled in alternative currencies. China's digital yuan was gaining traction across Southeast Asia. India's rupee had found its way into oil contracts with Russia and Iran. And countries like Brazil and Saudi Arabia were diversifying into gold, euros, and yuan-linked assets, not just for returns, but as insurance against political risk. At the heart of this shift is a growing concern that America's political and legal systems are no longer stable enough to support global financial leadership. When Japanese and Korean investors watched the U.S. impose sweeping tariffs, ignore WTO rulings, and challenge federal court decisions, all in the span of a few months, they started asking hard questions, not about the dollar's past, but about its future. In 2025, the U.S. escalated tensions with Europe by slapping a 200% tariff on European wine, a retaliatory move tied to tech-related fines on American companies. France, Italy, and Spain didn't wait long to respond. They hit back with targeted penalties on U.S. pharmaceuticals and aerospace exports. But the real shock came not from Europe's retaliation, but from Washington itself. When a federal court issued a ruling to temporarily halt tariffs on Korean chip exports, the Trump administration defied the order and moved ahead anyway. Legal scholars called it a constitutional red flag. Even Chief Justice John Roberts issued a rare public rebuke, warning that the credibility of America's institutions was being openly tested. That credibility matters to global markets. According to Credit Suisse, after the court standoff, 5-year U.S. bond default insurance, known as credit default swaps, spiked by 14 basis points overnight. That's not just market noise. It's a sign that investors are beginning to question whether U.S. law still binds its leaders. Once the world's ultimate safe haven, the U.S. is now being watched through a different lens. Not just as an economy, but as a system under strain. When trust in your currency slips, you lose influence. But when trust in your rules erodes, you risk something even bigger: losing your role as the world's anchor. The world isn't waiting for America to fix itself. It's already moving on. Quiet shifts are becoming bold moves, and longtime allies are no longer acting like followers. The dollar still holds the crown, but the loyalty that kept it there is fading fast. As economic pressure builds and legal norms bend, the real question isn't whether the dollar can survive, but whether global trust in the system behind it can. If the rules are uncertain and the leadership unpredictable, why should anyone keep playing the same game? If you found this eye-opening, hit like and subscribe, and check out our deep dive into how countries around the world are ignoring U.S. demands on tariffs.